Hey guys, what's up? I'm Weston McKinley. Welcome back to RWM Finance. And today I wanted to talk about why good funds turn bad. So you're starting your investing journey and you're looking at mutual funds because that's what you've been told offers, great returns with some good diversification as well. So naturally you want to select the fund or a fund with some great returns, and you expect them to keep going in that direction. The thing is, these hot, actively managed funds often turn cold just as quickly as they turned hot. Financial scholars have actually been studying mutual funds for over a half a century. All are virtually unanimous on certain points according to The Intelligent Investor by Benjamin Graham. The average fund does not pick stocks well enough to overcome the cost of researching and trading them. The higher a fund's expenses, the lower its returns. The more frequently a fund trades its stocks, the less returns it gets. Highly volatile funds, meaning that they go up and down, are likely to stay volatile. And funds with high past returns are unlikely to keep those high returns. So if you haven't subscribed, please scroll down, click that subscribe button and the like button for the YouTube algorithm, and we're going to keep going. So we're really going to zone in on that last point because I feel like that's the one that gets most investors trapped in these mutual funds with high costs and with, the returns that they think are good, but in the end they aren't probably going to last. Those mutual fund managers, they flash those high returns and it catches the eyes of these new investors, and then all of a sudden they get trapped in these funds with high fees and then low returns. But I wanted to talk with y'all about why more winning funds, like those ones that flash those high returns, don't stay winning. Or how I put it, why good funds turn bad. I figured it was a little bit more catchy. So the better a fund performs, the more obstacles its investors face. Now, our first obstacle that investors face that will cause a good fund to turn bad is migrant managers. So when a stock picker or a fund manager seems to have the Midas touch and everything seems to be going well, all of his funds getting great returns, then everybody wants him, and that includes rival companies. So if you buy into a fund that has great returns, that could quickly change because a rival firm or a rival company comes in and picks up that stock picker, and then they hire him. And then now you're just out of luck. Another reason that good funds turn bad is due to asset elephantiasis. So when funds earn high returns, their investors notice, and this causes them to pour millions of dollars into that fund in a really short period of time, say to like a couple days to a week. This leaves the fund manager with only a few options, and the sad thing is that all of them are really bad. So the first option that the fund manager has is that he could save that money and put it up for a rainy day. But then the low returns on cash will crimp the fund's results if the stocks were to keep going up. Meaning that if the stocks were to keep going up and he didn't invest that money into his fund and he actually put that money up for a rainy day, the investors would get upset because they poured all this new money in and they didn't get the expected returns that they wanted, even though their stocks went up. Option number 2 is that he could put that money into the stocks he already owns, which have already probably gone up since he first bought them and will become dangerously overvalued if he were to flood millions of dollars into them. Option 3 is that he could buy new stocks that he didn't like well enough to own. This means that he's going to have to do research on these stocks from scratch, meaning that he's going to have to start over and do research on them and try and see which ones that he didn't like now he's going to have to invest in. This means that he's going to end up having to watch more companies than he's used to and wearing his attention thin, causing him to probably not know what to do at certain times, being with all that money invested in so many different companies. So another reason that good funds turn bad is because they no longer have fancy footwork. So some companies test their funds out privately before selling them publicly, which honestly sounds like a good idea, right? But wait, let me finish. Typically, whenever these funds are invested in privately, they are invested in by employees and affiliates of the company. This means that they keep them small, so by keeping them tiny, the fund manager can test drive his idea of a certain fund with these risky strategies that work best with small sums of money. If his or her strategies work, then they can broadcast these high returns that they got with that fund. But don't forget that these were employees and affiliates investing in that fund, so they didn't have those extra fees tied on to it, which causes that fund's return to be higher. But if, say, you or I were to go and invest that fund, they would slap a fee right on top of that, and that automatically lowers their returns. So after these fund managers attract all these new investors with those high returns that they broadcast, once they slap those fees on there, those returns for those new investors just become mediocre. So another reason that winning funds stop winning is because of rising expenses. It often costs more to trade stocks in these very large blocks than it would in smaller ones, because there are fewer buyers and sellers, so naturally it's harder to find a match. A fund with 100 million in assets might pay around 1% a year in trading costs. But if the high returns cause that fund to grow to be 10 billion in assets, its trades could easily eat up 2% of its assets. And the typical fund only holds on to its investments for around 11 months. So trading costs could really eat away at a fund's returns like acid. The more trades a fund makes, the more that gets eaten away by all these trading costs. But that's not even the only cost. With operating expenses at 1.5% and trading costs around 2%, the typical fund has to beat the market by 3.5% before it even makes any money. Lastly, another reason that good funds turn bad is due to sheepish behavior. Finally, once a fund becomes successful, the managers of that fund tend to become timid and imitative. As funds grow, its fees become more lucrative for its managers, making them not want to rock the boat in order to keep collecting all those fees. The very risk that they took to get those initial high returns could drive investors away, and they do not want to disrupt that fee income that they are getting to fatten their wallet. On to being imitative, the majority of growth funds all own almost identical shares and proportions of major companies. But by protecting their fee income, fund managers compromise their ability to generate superior returns for their investors. So with all this being said, what should you do as an investor? Well, I'm not telling you what to do, but maybe you should think about looking into index funds. An index fund that owns all the stocks in the stock market all the time will beat most actively managed funds over the long term. You're probably thinking, yeah, there's gotta be a catch to this though. And you would be right. The problem with index funds is that they're boring. You're not gonna go to a family outing or a family reunion or a barbecue or something like that and brag to everybody about how you own the top returning fund in America. But as the years pass, the cost advantages of indexing will keep accruing relentlessly. Hold on to an index fund for 20 years or more and keep adding money to it, and you are all but certain to outperform the vast majority of actively managed mutual funds. So guys, those are some of the reasons that good funds go bad. After hearing all those reasons they do, what are you gonna do? Are you gonna take your chances and try to pick a mutual fund that's winning that will last? Or will you go with another option like the index fund? Whatever you do choose, I hope that it works out for the best, and good luck. Well guys, I hope you enjoyed this video. If you did, scroll down, give it a like, and subscribe to the channel below. Leave a comment, suggestion, whatever, question, whatever you have, leave it down there. I read just about everything, so I'll get back to you. Follow us on Instagram at RWM Finance. Make sure to check out the list of books in the description bar below. I'm doing that for you guys. I hope that they would really help. I mean, they help me, so I feel like they would help you. Remember guys, I post videos every Monday, Wednesday, and Friday, so make sure to tune back in for the next one. Y'all have a good day, and I will see y'all in the next video.